Hello, everyone. Today is Monday, February the 17th, 2025, and this is the Just Dario Daily. The title of today daily is The Consequences of a Gold Tsunami Eating the Lbma. The 2013 gold market crash, triggered by a sudden collapse in COMEX future prices, exposed vulnerabilities in the gold global trading system. At that time, paper gold markets, dominated by future contracts and speculative trading, overshadowed physical demand, creating a fragile equilibrium. Investors watched in disbelief as prices plummeted nearly 30% in weeks, eroding trust in financialized gold instruments and sparking a flight to physical bullion. This event reshaped market behavior, revealing how interconnected paper and physical markets could amplify systemic risks. Over a decade later, the London Bullion Market Association, a cornerstone of physical gold trading, faces its own set of challenges as shifting dynamics between COMEX and Lbma suggest new vulnerabilities. In April 2013, gold prices plunged from $1,600 per ounce to below $1,200 per ounce, a drop fueled by speculative trading, margin calls, and algorithmic selling on COMEX. The crash highlighted the disconnect between paper gold, future contracts, and physical gold demand. Investors rushed to redeem futures for physical metals, straining COMEX delivery mechanism. Meanwhile, Asian markets, particularly China Shanghai Gold Exchange, saw surging demand for bullion, absorbing the metal flowing out of Western vaults. This divergence underscored a growing tension. Paper markets dictated prices, but physical markets revealed true scarcity. The aftermath saw stricter margin requirements and a renewed focus on physical holdings, as investors questioned the sustainability of leveraged trading. The 2013 crash reshaped gold's role in portfolio. Investors shifted towards physical gold ETFs, allocated accounts, and sovereign coins, while central banks, led by China, Russia, and India, accelerated gold acquisitions to diversify reserves. COMEX dominance waned as SGE influence grew, though London's Lbma retained its status as the hub for institutional trading. Regulatory scrutiny intensified, with calls for transparency in both holdings and lease rates. Yet the structural imbalance persisted. Paper gold volumes dwarfed physical supply, leaving markets vulnerable to future shocks. A decade after the COMEX crash, the Lbma today grapples with similar mounting problems. While COMEX remains the epicenter of futures trading, its prices increasingly diverge from Lbma's spot benchmarks. In January, COMEX gold at one point traded at $50 premium to Lbma prices, driven by surging US demand and fears, according to mainstream media, of tariffs on imported bullion. Unlike COMEX, which relies on paper contracts, the Lbma's credibility hinged on its vast physical reserves, officially amounting to 8,535 tons of gold stored in London vaults. However, recent withdrawals have strained logistics, with delivery times now stretching to 8 weeks, not only raising doubts about Lbma's ability to meet demand during crisis, but also about the actual amount of physical gold bars stored in its vaults. A COMEX-style meltdown in Lbma would unfold differently. Imagine a scenario where investors lose faith in Lbma unallocated gold, that are paper claims on metal, and demand physical delivery en masse. Both operators, already contending with declining stocks and bond shortages, might struggle to fulfill requests. Lease rates, already spiking to 12%, will skyrocket, signaling acute scarcity. Unlike 2013, where COMEX paper market collapsed, a Lbma crisis will directly threaten the physical supply chain, destabilizing central bank reserves, as highlighted last week in the article The Potential Consequences of a Short Squeeze on BOA Gold Exposure, and the ETFs backed by London Metal. Both operators like HSBC, JP Morgan, or the Bank of England, custodians of Lbma gold, will face liquidity crunches if withdrawals exceed reserves. Refiners, already stretched by production delays, might buckle under demand to convert scrap or mine output into deliverable bars. Market makers, The bullion bank that stabilized prices could falter if arbitrage between COMEX and Lbma breaks down, exacerbating price gaps. For example, if US tariffs disrupt gold imports, refiners in Switzerland or Turkey might struggle to redirect supply, leaving Lbma vulnerable. Short-term, an Lbma crisis could easily propel prices beyond $3,000 per ounce as panic buying overwhelms supply. Medium-term, prices might stabilize as central banks intervene or recycling surges, but structural deficit in mine output, down 60.8 tons in 2024, could sustain elevated levels. Long-term, a systemic breakdown might accelerate a monetary reset, with gold reclaiming a formal role in central bank balance sheets, a shift hinted by Basel III Tier 1 status for gold. If Lbma paper market unravels, central banks storing gold in London, like Germany, the Reserve Bank of Australia, or the IMF, could repatriate reserves, mirroring the US recent repatriation effort. A loss of confidence might also spur a rush into alternative markets like SGE in China, shifting pricing power to Asia. Economies reliant on dollar liquidity could face turmoil, while nations with large gold reserves, for example China and Russia, will gain leverage in trade negotiation. For retail investors, the lesson is clear. Physical gold held outside the banking system remains the ultimate edge against systemic failure.